Hello everyone. So welcome to chapter 14, that is company analysis. So let's start. So we have discussed in last class what is fundamental analysis and what is technicals. So in technicals we discussed that we focus on chart and patterns to try to find the behavior of the market and try to predict where the stock prices are going. In fundamental analysis we study the economy, we study the industry, and then we study the company to find which stocks are undervalued and which stocks are overvalued. Now, in the last class, we discussed about industry analysis and economic analysis. We were left with company analysis. In this chapter, we are going to discuss about company analysis. So, company analysis is the process of examining company specific factors that can influence investment decisions. We'll discuss analysis of financial statements and ratios in this chapter. So, first statement that we are going to discuss is statement of comprehensive income. So if you remember, we have covered this in level 1. Statement of comprehensive income start with sales. Then from sales you deduct cost of goods sold. You get gross profits. From gross profit you deduct interest. You deduct depreciation, you deduct amortization, and you deduct taxes. Finally you get profits that are there for shareholders. So in income statement, what you're doing is you're starting with revenues and boiling down to profits. Now, as a shareholder, first concern that you have is revenues, that is top line, that is sales. Now, a growing trend in revenues is desirable. So if the trend is falling, that is if sales are falling, it doesn't make any economic sense to invest in that company. If it is a minor fluctuation because of business cycle, still you can consider, but if it is a consistent declining trend in revenues, then the company is not adding any value for shareholders. It is not gaining market share, its products are not selling, all those things. So as a stock investors, it is important that revenues should have a growing trend. Now, along with this growing trend, we are also interested in reasons for growth of sales. So increase in prices and volume is generally a positive sign. Sorry for this pops up. Sorry for these pop-ups. So increase in price or volume is a positive sign. Introduction of products is a positive sign. Expanding to a new geography, for example Tesla starting a factory in Shanghai in China, it's a good sign. Takeovers, it depends on what the takeover is for. Some companies try to hide losses by doing mergers and acquisitions, so in those cases mergers and acquisitions are not good. But if it is adding synergy to your company, if you can extend your skills of management of your product or your innovation or distribution chains to the company that you are acquiring, then it still makes sense. Gaining market share is a good reason. Aggressive advertising may bump up your sales, but you have to be careful about it. Aggressive advertising may not be a may not lead to consistent increase in your revenues. Strike at competitors, so this can bump up your revenue for a particular quarter, but this strike may not continue in future, so that also you need to factor in. And finally you need to factor in business cycles. So as the business cycle moves, the revenue moves. So what is the dependence of revenue of a company on the business cycle that is going on? Some companies are extremely dependent because they are in the cyclical industries. Some companies are part of defensive, so they are not, they have stable revenues even in recessions. Next is operating costs. So operating costs are generally manufacturing costs that go into making the finished product. So they are always seen in relations to sales. So if sales are increasing and costs are increasing at the same pace, as a ratio the ratio would remain same. But if sales are growing faster than your cost, then you are adding efficiency. But if sales are growing slower than your cost, so your cost is increasing but sales are not increasing to that extent, then you're losing efficiency. So operating cost should always be seen in relation to sales. There can be rising trends or falling trend. As an analyst, you would hope for a falling trend. Falling trend means that the efficiency of management to control cost is improving. Cost can increase because of two reasons. Increasing commodity prices can increase cost. An introduction to of new products may bump up the cost initially because of R&D, but it generally leads to better profit margins. So if you spend on new product innovations, generally automation leads to good profit margins. The third thing that we look at is dividend record. Generally, as an analyst, we want companies to pay stable dividend and increasing dividend, but we also need to figure out what is the reason for paying dividend. So if reason for paying high dividend is stable earning, it makes sense. If the earnings are growing, if the earnings are stable and the company is increasing its dividend, then it makes sense. But if earnings are declining and just to make investors happy, the company is paying more dividends, it may indicate that future cuts in dividend would be likely. Also, if earnings are based on resources, like for mining and oil and gas companies, so if resources are running out, if they're running out of resources and they're increasing dividends, that may lead to future decreases or future cuts in dividends. Also, an important factor is low payout. So low payout is generally not desirable, but it can be a valid reason if earnings are reinvested. So if a company is growing and has a lot of opportunities and needs a lot of money, so what it would do, it would reinvest its earnings. So if such a situation is happening whereby the company is reinvesting its earnings, then a low payout may be a valid reason. Or if company is buying back shares instead of paying dividends, that also can be a cause of low payouts. Next is statement of financial position. So it gives you capital structure. So it indicates what is the debt, what is the assets, and what is the equity. So if you have large debt, so this large debt has to be refinanced, and in an increasing interest rate environment, the one we are under, we are in which, so in an increasing interest rate environment, the refinancing cost can go up. So that may lead to a big cost overhead. So it is important that if you are investing in a company with large debt, you have to focus on when is the refinancing due. If refinancing is due, the cost may increase. Retractable securities may have to be refinanced. For example, if bonds and debentures have a retractable function, have a call function on them, in which investors can give their security and ask for money, then in such cases you have to have refinancing provisions. And finally, convertible securities like warrants and employee stock options, so these may lead to dilution. So whenever you have large dilution, you have to figure out what would be the impact of those dilutions on earnings. Dilution is you're adding additional shares without any cost, means you're adding additional shares without any money intake for the company. For example, in case of employee stock options, employees can convert those options and get stocks. So in such case, it may dilute earnings for existing shareholders. Finally, we have to look at the effect of leverage. Leverage is if a company has large fixed cost can be in interest or it can be in preferred stocks. So if the company is paying fixed interest or it is paying fixed dividends, then in such a case, company has leverage. So leverage means if sales are increasing, the earnings will show a larger impact of that increase. And same way, if sales are decreasing, earnings will show a larger impact of that decrease. So their earnings are more volatile if a company has large debt or preferred stocks. So leverage companies are more volatile, their earnings are more volatile, and they have higher risk. But it doesn't mean that they are bad. So, for example, if an expansion is happening in the economy, earnings of leveraged companies will always react more than earnings of unleveraged companies. So you have to figure out what is the economic situation and what would be the impact on those earnings. But generally, leverage companies have higher risk and higher volatility of earnings. Other features of company analysis, so look all along with looking at these financial statements, you also have to look at other factors like qualitative analysis. What is the management effectiveness? What are the other intangibles, like what is the growth prospect, what are the innovations that the company is doing, what is the general market sentiments, what is the corporate social responsibility that the company undertakes, etc. Along with that, you also look at liquidity of common shares. So if you're investing in a stock, you should be able to sell it. So it is important to look at the liquidity. Continuous monitoring is required whenever you invest in stocks. So financial situation or non-financial stuff may be changing, so you need to continuously monitor your investments. And you look at non-financial stuff, you look at the financial statements, and also it is important to read notes to financial statements, because generally companies follow IFRS. Now IFRS has lot of flexibility, so company has lot of flexibility on how they represent their data. So it is important to read notes to financial statements because they make you understand what is going on. So examples of important things that can be disclosed in notes can be changes in accounting practices that can increase or decrease expenses without business actually doing well. Changes in company's auditor, it's not a positive sign if a auditor has been recently fired. There may be a case that auditor came across some kind of discrepancy, and because of that the company's management changed auditors. So changes in auditing team has to be carefully reviewed. Acquisition of smaller companies to manipulate consolidated statement. When you acquire a smaller company, you merge financial statements, so that may lead to a positive impact that may not be sustainable. And also you need to check for mergers that are done to hide losses. Next is trend analysis. So in trend analysis, what we do is there is a series of data. The first year's data we generally consider to be base. So base would be, let's say, first year's data and 100, and everything else we represent in terms of base, and then we plot those trends to find whether the data is increasing, decreasing, or it's stable. So I'll show you for example. So let's say you're looking at earning per share of Apple. I'm just making up numbers, so don't sue me if the numbers are not right. So 2016, 2017 and 2018, you're looking at 3 years. The earning per share was 18. It was 20 in 2017 and it went to 25 in 2018. So how do you plot a trend of this? So first step is assume 100 for the first year's data. So 2016 EPS of 18, assume it to be 100. Then represent everything in terms of 100. So next year's data will be 20 divided by 18 multiplied by base assumption, that is 100. So current year's data divided by base year's data, not the previous year's, base year's data into 100. Next year it would be current year's data divided by base year's data multiplied by 100. And then you plot this data on graph which shows you trends. Okay. Now before we move to ratios, one thing is, along with this, a percentage change method can also be used, but the book says that percentage method is more complex to create, so trend is widely used. Now what is ratio? Now this is a bit of mathematics before we start with financial ratio. So a ratio is one variable expressed as another. So it has two parts, numerator and denominator. There are two possibilities. There can be an increase in ratio, which is caused by increase in numerator or decreasing denominator, and there can be decrease in ratio, that is caused by decreasing numerator and increasing denominator. Now whenever you look at ratio, you have to figure out whether the ratio has increased or decreased, and then you have to figure out whether the numerator has increased or decreased and denominator has increased or decreased, and what is good for you as an analyst. So this is extremely important to understand why the ratio increases and why the ratio decreases. Ratio increases because numerator is increasing or denominator is falling, and decreases because numerator is falling and denominator is rising, and or. Okay. Now ratios can be compared with past. If you're analyzing a company, let's say you're analyzing Apple, so you can compare Apple's ratio current year versus Apple's ratio in its past. So it can be compared with its past. This is called as time series. Or it can be compared with its competitors. So let's say you're comparing Apple's ratio with Samsung. So Samsung is a competitor for Apple, so you compare Apple's ratio with Samsung. You can also compare it with average of industry in current year. So let's say 2018, the mobile manufacturing industry or mobile sales industries had an average of XYZ, and then you compare it. Or you can compare it with industry standards. Now industry standards are generally long-term averages. Now it is important that industry average is the current year's average, so it changes every year, but industry standards are generally long-term averages, so they don't change much. Okay, so industry average and industry standard is different. Now we are going to see different types of ratios. So majorly four types. Liquidity ratio, it is used to judge company's ability to meet its short-term commitments. So it shows whether the company will sustain in the short run. Risk analysis ratio, it shows how well can a company deal with its long-term debt. So whether the company can sustain in the long run, whether it can pay off its debt and continue growing and continue doing business. Then you have operating performance ratios, that indicates management's efficiency, so how well the management is making use of the resources. And value ratio, are you paying the right price? That is decided by value ratio. Now liquidity ratio, first type is working capital. Now this is an important ratio. It has current assets in numerator and current liabilities in denominator. Now what are you doing? Means you are trying to figure out whether the company has enough current assets to pay off its short-term liabilities. So whatever liabilities are due in short term, whatever the short-term credits are there, whether the company can pay it off. If it is not able to pay it off, the creditors may sue the company and it can lead to bankruptcy. So it is important to understand whether the company can sustain in the short run by paying off its short-term liabilities. Generally, increase in this ratio is good. Now, an important part is current assets also include inventories. So in numerator, you have current assets, that is composed of cash, short-term investments as well as inventory, and in denominator you have current liabilities, that is composed of short-term liabilities and current portion or the due portion of long-term liabilities in the coming year. Now it is important to understand that inventory is a part of numerator, that is part of current assets. Now to convert inventory into cash, you have to sell it. Either you sell it as a product or you sell it as a scrap. So inventory can lead to a wrong view of liquidity because inventory may not be easily converted into cash. Suggested ratio is 2 is to 1, but it depends on type of business and industry. Generally, companies that have stable earnings, that is stable cash flows, can have a lower ratio, but companies that are generally not having stable cash flows generally need to have better liquidity. So you're analyzing company ABC. So ABC's ratio in 2017 was 2 and its ratio in 2018 working capital ratio is 2.6. So the ratio has gone up. Now again back to our basic math discussion. When will this ratio go up? This ratio will go up when current assets are improving or there are lesser current liabilities. So if current assets are improving as compared to its liabilities, the liquidity position of company is improving, which is a good sign. So as compared to its past, the company is doing a good job. Now its XYZ is the biggest competitor. So as compared to competitor, it is doing a good job even right now. So 2.6 versus 2.2. So it has more liquidity as compared to its competitor. It is doing better than the industry average right now, and it is doing better than the industry standard. Next ratio is quick ratio. So last ratio we discussed, there is an issue with inventory. Inventory may not be so liquid. So to avoid this issue, we remove inventory from numerator. So quick ratio is constructed by removing inventory from numerator. This ratio increases when current assets improve, that is cash and short-term investments are more as compared to current liabilities. It is more stringent and increase is generally good. Suggested ratio is 1 is to 1. Now the issue with liquidity ratio is if you have too much liquidity, let's say your working capital ratio is 10 and the industry is running at 2. Now you have lot of inventory and this may be a cause of concern and it's a sign of financial mismanagement. Either you have more inventory than you desire, or your inventory is absolute, you cannot sell it, or you have over invested in inventory. So one of the reasons, so it can be a cause of financial misconduct. So generally both these ratios, higher is better, but you have to be careful with working capital ratio. Too high indicates financial mismanagement. So you're comparing quick ratio now. So it is 1.4, it was 1.4 in 2017. Now it has gone down to 1.2. So as compared to its past, the ABC's liquidity position has deteriorated. So it has lesser assets versus its liabilities. Then as compared to its competitor, the ratio is low. As compared to industry standard and industry average, the ratio is low. So company has bad liquidity as compared to its competitor, industry average and industry standard. Now these questions, I would insist you to pause, think about it, and then again play to understand my answers. So the first case is a large debt payment becomes due. What will be impact on current ratio? So if debt payment is becoming due, it will increase the current liability. Now if current liability is increasing, the denominator is increasing, which leads to a lower ratio. If the company wrote down its inventory due to obsolescence, what will be impact on current and quick? Now in terms of current ratio, inventory is a part of current asset. So if inventory is writing down, it's going down, numerator is going down, so this ratio will go down. But in quick ratio, we do not consider inventory, so inventory is not a part of it, so ratio is not impacted. Next is risk analysis ratio. So we focus on riskiness of the company. So we try to focus on debt, long-term debt of the company. So we show short-term debt in liquidity, long-term debt we look at in risk analysis. So is the long-term debt reasonable? Can the company pay interest as measured through interest coverage ratio, or what is the company's ability to pay debt measured through its asset coverage and cash flow to debt ratio? So the next ratio in risk management, the first ratio is asset coverage ratio. So purpose of this ratio is access the debt holders protection provided by company's tangible assets after removing all liability. So simply put, it means how much asset you have to pay your debt. If the company closes down, can all debt be paid? That is what we are looking at, because assets, you will use assets to pay off debt when you cannot make debt payments through your earnings. So do you have enough assets to pay your debt? So it generally indicates riskiness of doing business, means riskiness of investing. If asset coverage ratio is too low, you don't have enough assets to pay your debt, you're highly leveraged, and if something goes wrong, then the company can be bankrupt and you can lose money. So numerator, you have tangible assets, where from which we generally remove goodwill. Goodwill is removed because it cannot be converted into cash, and you also deduct this. And denominator, you have total debt outstanding. Increase in this ratio means you have more asset to pay your debt. Decrease means you have less asset to pay your debt. So generally increase in this ratio is good. Industry standard for this ratios varies from industry to industry, in part due to stability of income provided by the company. Utilities, for example, have fairly stable source of income as they are characterized by heavy investment in permanent property, which accounts for a large part of their total assets. They are also subject to regulation, which ensures utility a fair return on investment. So this ratio is different from industry to industry, but industries that have stable source of income can even go away with lower asset coverage. But when the source of income is not very stable, then you need to have better asset coverage. So you're analyzing asset coverage for ABC. ABC's ratio is 5 in 2017. It went up to 7 in 2018. So asset coverage has improved. So company has more assets for its liabilities. That's a good sign. As compared to its competitor and industry average, it is good, but as compared to industry standard, it is not good. So industry right now, the industry average is lower than industry standard. So current year industry is not having much asset coverage. So either the entire industry has taken on more debt, or it has reduced its assets as compared to its past. But company ABC is performing better as compared to competitors and the industry. Next ratio is debt to equity ratio. Shows the portion of borrowed funds used relative to investment made by the shareholder. In numerator, you have total debt, long and short, and in denominator, you have equity. Now, debt is riskiness. If you have too much debt, you have high risk of investment. So generally we aim for, if the ratio is reducing, it means that the company is reducing its leverage, reducing its riskiness, and reducing volatility of earnings. If the debt burden is too large, it may reduce the margin of safety protecting debt capital holders. Financial risk also increases. So increase is generally not considered to be good, decrease is considered to be good. If you're analyzing ratios of this company, so ABC had a ratio of 0.9 in 2017, that improved to 0.75, which is a good sign because it improved. So debt is going down, debt is in numerator. If ratio is shrinking, numerator is shrinking, so that is debt is shrinking. XYZ's ratio, competitors ratio is 0.5, and industry standard and industry average are 0.4 and 0.5. So though the company has reduced its debt, it is still having significant debt as compared to competitor as well as industry in general. Next is cash flow to debt outstanding. So it measures the ability of a company to repay the fund it has borrowed. In numerator, we have cash flows from operations, and in denominator, we have total debt outstanding, long and short. So what are you doing? You are trying to figure out whether the company has enough cash flows from its operations to pay debt. and what portion of debt can it reduce if it wants within a year. So increase in this ratio means your cash flows are rising or your debt is shrinking. That's a good sign. Decrease is not so good because cash flows would fall and your debt would rise. If you're analyzing a company, so in 2017 the ratio was 0.6, now it has gone down to 0.45. So what does it mean? Cash flows has gone down as a percentage of debt. So that's not a good sign, but as compared to industry and competitors, it is still doing a decent job. Interest coverage ratios measures the ability to pay interest on debt. Standards vary from industry to industry. It is a key ratio for rating companies. So in numerator you have profits before interest, and in denominator you have interest charge. So what are you doing? You are looking how many times can your profits cover your interest charge. So example, if this ratio is 10, it means you can pay interest charge 10 times through current earnings. So increase is generally good, decrease is not considered to be a decent sign. So ratio in 2017 for ABC was 17, now it is 10. Competitors ratio is 11, industry average 9, and industry standard 8. So what does this mean? This ratio has fallen as compared to past. So company has lesser earnings for paying its interest charge. So either it has taken on more interest or its earnings are falling. So both of this is not a good sign. As compared to its competitor also, it's not having a good interest coverage, but it's compared to industry in general and industry standard, it is doing quite well. So determine impact of company's debt ratio in each of the following situations. So the economy is in recession and profit falls. So fall in profit generally can be considered as fall in cash flow from operations and also fall in earnings before interest and tax. So if both these things are falling, cash flow to debt as well as interest coverage, both these ratios will go down. Okay. Now company completes a large equity issue, so that will have an impact on debt to equity ratio. So if equity is increasing, this ratio will go down. Next is operating performance ratio. It measures the profit left after various expenses, shows how well the management used its company resources. It is used to compare to others in the industry and historic performance. So generally operating performance ratios measures the efficiency of a company to retain profits. So first is gross profit ratio, that measures operating efficiency. How efficient is the company in its operation? How much profits can it retain out of the sales that it makes? Numerator you have revenue minus cost of sales, that is gross profit, and in denominator you have revenues. Increase is a good sign because it means you are retaining higher profits, and it also means that the management efficiency is good. Decrease is bad sign. So company's ratio in 2017 was 15%, in 2018 it was 0.2, that is 20%. So gross profit ratio has improved as compared to past, so management is getting more efficient, but as compared to its competitor and industry average, it is not as efficient as others. So industry is much more efficient and the biggest competitor is more efficient than the company, but industry standard it is still beating. Next is net profit. So we saw total efficiencies given by gross profit ratio, operating efficiencies given by gross profit ratio, total efficiencies given by net profit ratio. In numerator you have profits minus the share of associates, which generally is not there in most of the income statements. So in numerator you have profits and in denominator you have revenues. Increase means the company is showing more total efficiency, so it is retaining more profit. So increase is good, decrease is generally considered to be bad. So net profit ratio, if you're analyzing company ABC, so it was 40% in 2017, it is 30% now. So the ratio has gone down. That's not a good sign. But as compared to its competitors and industry, it is still having a better ratio. So though the efficiency, total efficiency has gone down as compared to past, the company is still more efficient than the biggest competition as well as the industry in general. Next is return on common equity, shows the dollar amount of earnings that were produced for each dollar invested by the company's stockholders. So it is how much percentage return does the company give you for amount of money you invested as a shareholder. So more the return, better it is for you. So in numerator you have profits and in denominator you have equity. So as an investor I would want more profits and lesser number of shareholders. So increase is generally good and decrease is bad. So if you're analyzing company ABC, ABC's ratio in 2017 was 24%. In 2018 it has gone down to 20%. So return on equity is falling. This indicates that management is not utilizing its resources in a good way. So that's not a good sign. As compared to its competitors, the biggest competitor XYZ has more ROE, but as compared to average and standards, the industry is still okay. That means the company ABC is still okay. Next is inventory turnover ratio, measures the amount of inventory in terms of sales. So numerator you have cost of sales and denominator you have inventory. So what it does, it tells you how many number of times are you selling your inventory in a year. Now as a business I would want to sell my inventory as often as I can, because that provides liquidity. Money is not blocked in my inventory. So increase in this ratio is good. Now reasons for low turnover can be that the inventory is unsaleable, you have overbought your inventory, or in accounting you have overstated your inventory. All these cases are not good, so we want a good inventory turnover ratio. So if you are analyzing company ABC, ratio in 2017 was 2, in 2018 it was 5. So ratio has gone up. So company is selling its inventory 5 times this year as compared to 2 times in past. So that's a good sign. It is a better liquidity position for the company, and it is performing quite well as compared to its competitor and industry in general. Next is value ratio. So first value ratio is percentage dividend payout ratio, measures the extent that profits were paid to common shareholders. Numerator you have common share dividends, denominator you have profit. So it tells you how much percentage of profits were shared with shareholders. Now generally we want a good dividend payout ratio, but it also means that company has lesser earnings to grow, right? So if company has good growth opportunities and the dividend ratio is falling because company is paying in reinvesting in itself, that is not so bad sign. So but and top level remark, generally increase in dividend payouts is good, decrease is bad. So you are analyzing company ABC. Company ABC's ratio in 2017 was 15%, ratio in 2018 has gone up to 60%. Now this is a means if it would have increased to around 20 to 25%, that would be still okay, but it's a big jump. So now you have to find out what is the reason. Whether the company doesn't have any growth opportunities, that's the reason it is paying very high dividend. So you need to figure out what has happened. As compared to its competitor and industry, it is still doing okay. Next is earning per common share, measures earning available to common shares. Numerator you have profits, denominator you have number of stocks, that is weighted average number of common stocks. Earning per share means how much dollar profit does the company make for one share. The more dollar profit it makes, better it is for you. Increase is good, decrease in earning per share is bad. Dividend yield measures investors' percentage return from dividends. So in numerator you have dividend paid and denominator you have current market price. Increase is generally considered to be good, but again with dividends you have to be careful. Why is the increase there? So dividend yield, you are analyzing dividend yield. So 17 it was 3%, in 18 it is 3%. So it is maintaining a stable dividend payout ratio, dividend yield ratio, and as compared to its competitor it is better, but industry average is higher. So others in the industry are paying more dividends and industry standard is little, it's almost the same. Next is book value per share. It measures how much protection does the common shareholder have. In numerator you have equity, in denominator you have number of stocks. So assets minus liability is equity. So net assets divided by number of stocks. It gives you protection. So higher the protection, better. So higher the book value, better as compared to market value. So you're analyzing company ABC, market price is 30, book value is 20. So what does it mean? That in worst case, the company, if it closes down, it sells all its assets, it pays all its liabilities, still a shareholder will be left with $20. So there is $20 of your investment is safeguarded right now, $10 is speculative. Next is price earning ratio. It is used to show how much an investor is paying for company's earnings, allows a common comparison between others in the industry. Numerator you have current market price, denominator you have earning per share over last 12 months. So price earning ratio is how much you are paying for $1 earned by the company. Now our objective as investor is to find good companies and pay less. So we ideally want PE ratios to go down or to be less than the competitors. So PE ratio generally increases in increasing stock market and it decreases in decreasing stock market, and high growth companies tend to have higher PEs, but as a thumb rule we want to invest in companies that have lower PE. So companies ratio is 10, PE ratio is 10, XYZ's ratio is 11, industry standard is 15 and 13. So ABC is trading at a lower PE. Next is dividend discount model. So it is a valuation model. Formula for it is price of any stock is all the future dividend the company is going to pay. So how do you find this price? So price is equal to dividend it will pay next year. So that's the next approximate dividend you're going to get, divided by R, that is the discount rate that is dependent on the risk of investing, minus G, that is growth of dividends. So price is current intrinsic value of the stock. Dividend 1 is the expected dividend paid out by the company in 1 year. R is the market capitalization rate or market consensus rate, also known as required rate of return. It is dependent on how much risk the company has. Higher the risk, higher will be the required rate of return. And G is the assumed growth rate for dividends. So I would urge you to solve this question. So it is current market price is 50 and they have given you some information. So expected dividend is 2.5, then it grows at a rate of 4% and required rate is 8%. So if you put it in formula, so intrinsic value will be 2.5, that is the expected dividend, minus R minus G. R was 8% and the growth rate was 4%. So your intrinsic value is 62. Right now the stock is trading at 50. So stock is undervalued. If your market price is less than intrinsic value, it is undervalued. If market price is higher than intrinsic value, it is overvalued. Undervalued stocks we generally buy. Undervalued stocks we generally buy. Now if dividend increases, what will happen to this ratio? This ratio will go up because dividend is there in numerator. If it decreases, the ratio will go down. If R increases, this ratio will go down because R is there in the denominator. So if required rate, if risk increases, this ratio goes down, and if risk reduces, this ratio goes up. Growth rate is subtracted from R. So if growth rate increases, this ratio goes up, and if growth rate decreases, this ratio goes down. A decrease in expected dividend will decrease the market share price. However, an announcement of increase in the expected dividend will increase the market price of the share. An increase in risk will mean a decrease in share price. An increase in growth of dividend will mean increase in share price. Now, whenever you're investing in preferred stocks, so you have to change your analysis a bit. So in preferred stock, preferred dividend coverage is important. So preferred dividend coverage means are your earnings enough to pay your dividends? So is the income sufficient to pay the dividend? Is it stable and is it rising? Equity per preferred stock, that is book value, is important. Is the equity adequate to repay the par value of the preferred? Record of continuous dividend payment is what we look for, and we also look for independent credit assessment. Other factors is cumulative dividends or sinking funds are generally good for you. Sinking fund means company has to put aside some part of its earning towards the preferred stock. That reduces your risk. Yield comparisons have to be done, so you have to compare yields across preferreds as compared to other debt investments. For convertible preferred, outlook of stock becomes important because conversion has value only when stock price is above the conversion price. And life of conversion privilege is also important. More life, better. So that's about it in this recording. We'll meet each other in chapter 15. Before going off, this weekend I went to Yellowknife. It is in northern, it is in north of Canada. It's a good place to go, and it has beautiful northern lights, and it is one of the best places in the world to watch northern lights. So if you have chance in your life, do visit it. It is north of Alberta in Northwestern Territories. So it is on the Arctic Circle, and the northern lights out there are beautiful. So if you get time, do check it out.